For a roll call, I think I want everybody to introduce themselves.
Yeah, that makes sense.
I'm gonna get it from here in a second.
Or if you want to just.
Okay. Yeah, no. His presentation is one that's missing, so it doesn't matter. If you wanna plug me in, can you pull it up from that, pull it and plug it into hers when she needs to? As soon as you want?
Okay. We're on live mic, so I'm going to start. Good morning. The Finance Committee meeting is called to order on Wednesday, March 20th at 11:02 a.m. For the committee's attendance, I have Alderwoman Finlayson remotely, and I have Alderwoman O'Neill to my left. I'd like at this time for everyone to introduce themselves. I'll follow in this room, and then we'll go remotely. Alderman Arnett.
You just did.
Thank you. Ms. Donnelly, and your title.
Julie Donnelly, Assistant Finance Director.
And everybody's,
She has to speak.
yeah, it's another way of making sure everybody is here and can hear us.
Julie Donnelly, Assistant Finance Director.
Thank you.
And Vicki Buckland, Assistant City Manager.
Okay. Anyone else on mic in this room? Director Dickinson? Director Dickinson, would you just want to introduce yourself as being here?
I'm Jody Dickinson, Finance Director.
And to your left?
Jason Ostrowski, Engagement Principal with UHY.
Okay. And to my right is our assistant here, Kaylin. City Council Associate. All right, remotely, I see someone with a seaside background. Could you introduce
Good morning.
yourself?
This is Jim Cardillo. I'm a member of the City of Annapolis Finance Audit Committee, and I was extended an invitation to participate.
Okay. Anne Marie? Oh, mic on? Green light or?
Sorry about that. I'm Anne Marie Baker, and I'm a citizen member of the Audit Committee.
And Alderwoman Finlayson, can you just check your mic and make sure you're all here and present? Oh, we can't hear you.
Good morning, Alderwoman Finlayson, member of the Finance Committee.
Okay, thank you so much. I'd also like to add that Alderman Arnett is a member of the City Council as well as Chair of the Audit Commission. So thank you all for being here and the effort made for us all to be here. At this time, I will entertain a motion to approve today's agenda.
Motion to approve today's agenda?
Second.
All in favor signify by saying aye.
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 Thank you. At this time, I will entertain a motion to approve the Finance Committee meeting minutes of March 6, 2024.
Move approval of the minutes from the March 6th meeting.
Second.
All in favor signify by saying aye.
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 Aye. Thank you. Next on the agenda is the Audit Committee presentation. Just for a little bit of background, our city code requires you to report to the Audit Commission, and we thought it best, the Finance Committee, that instead of you having two presentations, you already had a presentation to our FAC. We thought it best that we all come together and hear you. So a little bit of a going rogue with the city code, but it's in everyone's best interest to hear you. So without further ado, you can start.
So we like, do you want to get the slides up?
Yeah, if you want to, I can just walk through the results either way.
Okay, you can. He's going to start his presentation and we're going to get his slides up.
Fine, great. We'll check and make sure everybody can see your slides.
Okay.
Yeah, go for it.
you want to get them
And we're
up?
waiting.
I think he's going to start with that.
So
Is this presentation attached to the agenda?
We have on Granicus an audit committee presentation.
So
Yes.
that's mine. We have two different PowerPoints. I thought I was helping to save time, but apparently not.
Can I say the name of the presentation? Which one are you trying
It's
to pull up?
audit results presentation.
Audit results.
Yeah, the first slide has UHY.
So
City of
that's
Annapolis.
not, excuse me, that's not the one attached to our agenda.
I've just sent it to Madeline and Mark, and they're gonna pull it up in the studio and run it from there.
Final.
No, that's an ACFR.
Okay, can you press
Yeah.
this one?
I mean, it's not terribly exciting
single
PowerPoint.
Yeah.
The students.
So the first couple slides aren't really that
I can just walk
helpful.
through it.
He can start to walk through it, and then when they get the PowerPoint up, we'll show it on the screen.
We have attached a 14-page audit report.
That's mine.
All of that is yours?
Yes.
Okay, understood.
Okay. Yeah, I can just walk through the PowerPoint. I don't really need it up. I think most of what I was going to communicate was verbally, and what's on there kind of dovetails with each other. There's nothing exciting or schedules or tables or anything on there. So it's really, just wanted to present the 2023 audit results, the financial statements, as well as we also performed the single audit over the federal expenditures. So I always like to start with the headline. Kind of the primary piece of what we do is issue an opinion on the financial statements and whether they're materially stated in accordance with U.S. generally accepted accounting principles. So happy to report that it was an unmodified, clean opinion on the financial statements this year. So that's kind of the headline report, and then go through some of the other things included in our audit opinion, as well as the other piece that we walk through is some required governance communications at the conclusion of the audit. You also should have gotten in writing, we issue those same required communications.
Time out. My colleague Alderwoman Finlayson has her hand up.
Yes, I don't want to interrupt him, but I'd really prefer if we had the PowerPoint in front of us as he walks through it. I think that might be beneficial to everyone.
Okay,
So
I
could you wait one moment? In the meantime, there is a letter, a governance letter that's attached to our legislation. Oh, but there it is. I was going to ask a question about it, but here's the audit results.
Yeah.
Okay, perfect. Yeah, and I'll go through most of the required communications in that governance letter, and then certainly happy to entertain any questions that you have on that as well. But I might address them in some of the points in the PowerPoint, and if not,
So is your PowerPoint, I'm sorry to interrupt, your PowerPoint is your overview of the report. It's not part of the audit report. This is a
yes,
quote-unquote
this is just a
presentation.
covering, what
Okay.
was addressed in the audit report, as well as,
Like
like
an
I said,
outline.
there's that governance communication, which I think is the separate letter
Okay.
that was being referred to that go through some of those points as well.
And I also don't think you formally introduced who you are, your title, and the company for all of those listening.
Sure, yes. Jason Ostrowski, I'm a principal with UHY. I was the engagement principal on the financial statement audit, so just kind of overseeing and fully responsible for delivering the results and managing the relationship on the financial statement audit.
Okay, all right, we're ready.
All right, now I have a PowerPoint. So yeah, you can just go to the next slide, really just the agenda. I kind of mentioned that already. Going to walk through the 2023 audit results, as well as go through some of the required communications in that governance letter. And then you can go to the next slide. Like I said, the 2023 audit results, try to put the headline first there. That's our auditor's report on the financial statements. As you'll see there, unmodified, clean opinion on the financial statements. There's also a couple other pieces that are addressed in that independent auditor's report. The second bullet there, we perform limited procedures and issue an in relation to opinion on the supplemental schedules. So there's some supplemental schedules in the back of what's called the financial section of the annual comprehensive financial report. So there's an annual comprehensive financial report. Within there, there's the introductory section, the financial section, and the statistical section. And so we focus primarily on the financial section, and again, our opinion is on the financial statements and footnotes. There's some additional schedules, the supplemental schedules, which is a variety of combining schedules, so it kind of adds some additional detail to basic financial statements presented in the front. And really the point there is our opinion. We don't audit those supplemental schedules, but we do issue what's called an in relation to opinion. And again, that's a clean, unmodified in relation to opinion, and that's in relation to the financial statements as a whole. So we're auditing those in relation to the financial statements, not directly auditing. So again, a clean in relation to opinion on those supplemental schedules. The third bullet there, there's also additional information in that financial section. It's required supplementary information. There's the management's discussion and analysis, which is in the front of that financial section, as well as there's some schedules in the back that's additional required supplementary information over the pension plan and the OPEB plan primarily, and then there's a budget to actual schedule as well. So in our opinion, we don't issue an opinion on that required supplementary information, though we do perform limited procedures. We agree to supporting documentation, make sure it's presented in compliance with GASB, but ultimately don't issue an opinion on those sections, as well as the other two sections in that annual comprehensive financial report, the introductory section, as well as the statistical section. We don't issue an opinion on those, though again, we do go through that information, we read it, make sure it's kind of complying with what's in and agreeing with what's in the financial section, as well as going through that Government Finance Officers Association checklist, which kind of dictates the overall formatting of that annual comprehensive financial report. And so again, not issuing an opinion on those two sections, but we do perform procedures on them. And then the final bullet there is our audit of the federal expenditures. And again, happy to report that we issued a clean, unmodified opinion that there was material compliance with the major federal programs and the primary program that we tested this year. So we go through a sampling process of all the federal expenditures was the federal transit funds that passed through the Department of Transportation. So again, clean report, no compliance issues noted as part of our audit of those federal expenditures. Then you go to the next slide. Another piece of performing the audit under government auditing standards is that we issue a report on internal control over financial reporting, compliance, and other matters. And again, happy to report no material weaknesses or any issues identified in that report. So again, a clean report on internal controls. So that covers the audit results, and then the next couple slides are going to go through the required communications in that governance letter that you should have also received as part of our final audit results and communications. So the first bullet there really just highlights our responsibilities under generally accepted auditing standards. Our role in the process is to issue an opinion on the financial statements and whether they're materially stated in accordance with generally accepted accounting principles. And also like to highlight that management's role in the process is actual preparation of the financial statements, as well as the internal controls related to the preparation of the financial statements. And then second, significant accounting policies. There was a new GASB standard again this year, similar to the prior year. There was a lease standard that was implemented this year with subscription-based information technology arrangements. So it was a very similar standard to the lease standard as far as the implementation and how it appears on the financial statements. Essentially, any subscription-based IT arrangements now that you're paying kind of on a monthly basis, there's an assessment that happens and certain criteria are met, they're put on the balance sheet, essentially similar to what the leases were last year. So you're recording an asset and a liability, essentially. So no impact on the net assets of the city, but really just, again, moving those to the balance sheet rather than just being expensed every year. So not a major change. I think it was only $1.5 million, but really want to highlight that that is a change from prior years and a new standard implemented. Otherwise, as far as accounting policies and presentations, should be pretty similar to the prior year. The next bullet, required disclosures, is any management judgments and accounting estimates that are significant to the financial statements. We're required to report those. There's several of them in the financial statements. You'll see them there: depreciation, self-insurance liability. In the pension, particularly, there's the valuation of the alternative investments, as well as the actuarial assumptions and methods that were used for both the pension liability and the OPEB liability, as well as there's some estimates and assumptions used in recording those leases as well as those, they call them SPITA, but the subscription-based IT arrangements. And so we reviewed all those estimates as part of the audit process and found them to be reasonably stated in relation to the financial statements as a whole. Go to the next slide. So no corrected or uncorrected misstatements. Essentially, we had no audit adjustments identified during the audit. So certainly good news there. Nothing in our procedures identified anything that required an adjustment. And then also an uncorrected misstatement would be anything that we identified that may not be material, that wasn't made, and we had none of those as well. So again, kind of tying into the clean audit report. And really the overall process, which goes into the next bullet, it's always a pleasure working with Jody and Julie. Everybody was cooperative, very professional. And, I know they take on a lot, and we certainly appreciate all the assistance they give us. That makes our lives either easy or hard as auditors if you're working with a good management team, and certainly happy to report that you have a good one here, and they were a pleasure working with. And so no issues there throughout the process. No disagreements with management. Then a couple other just perfunctory. Management did not consult with any other accountants on the application of GAAP or GAS, and no outside accountants were consulted or provided any guidance, and there were no major issues discussed prior to our retention. And then the last piece, management representations. So at the conclusion of the audit, management provides us with written representations. It's required under audit standards as part of kind of the conclusion of the audit, just representing so that they provided us with all the information. There's no misstatements or anything. All the information presented in the financial statements is accurate as far as management's aware. So we received those representations from them at the conclusion. And then I think that concludes my presentation of the audit results and then the communications, and certainly happy to address any questions you had regarding the audit. And I think Jody's going to walk through the financials in a little bit of detail, but we can pause here.
Yeah, yes, I'd like to take time to answer questions. I just have a few, helicopter view without getting into the, micro level of the report. How much time did you spend on this audit, physically here versus remotely, just to get an idea of your investment of time?
Hours?
Yeah.
I think the audit is overall, it's about 750 to 800 hours of work. And, I think we're probably spending 10 to 15% time on site. Most of it is in the planning. We come back out when we're doing the actual detailed testing to look at some documentation. But, with technology, that probably used to be 95% on site. And now technology and just the working arrangements have allowed us to do a lot of things remotely that we used to do in person. So certainly that is skewed, and COVID had a big impact on that as well,
Right.
changing how we do things. But yeah, I'd say about 10 to 15% of those 800.
Okay, just two more questions. You mentioned this year that there were no material weaknesses versus last year. Last year, I do remember we had some material weaknesses. Those were corrected and
Yes.
and cleaned. That's
Yeah, that was related to the construction in progress and just identifying those. So yeah, processes and controls were put in place, and that was remediated this year.
okay. And then you mentioned the term self-insurance liability. Could you explain what that means?
Yeah, so you're self-insured, and essentially there's an actuarially calculated liability related to future unknown claims. So it's kind of capturing the claims that they call it incurred but not reported. So it's claims that were incurred that you just don't know about yet. And so the actuaries have a process to go through to calculate those essentially and book those as a liability as of your year end, because the idea is that something happened before year end and you just don't know about it. And so there's kind of an estimate that takes place there of using a lot of history, and then there's some actuarial assumptions built into it. Most of it's just based on, how often did you have claims come in from prior years after the fact. And the idea of that is just picking up the liability related to those, and it kind of ties in, and the reason it ties into that self-insurance is because you're paying the actual claims versus
Okay.
just paying a premium and the insurance company picks that up.
Okay, having given the courtesy of looking at the ACFR and sort of red dotting it, if you will, for math, I was just curious, what is your meaning of adjustment? Are those mathematical adjustments? You said that no quote-unquote adjustments had to be made.
An adjustment would be an actual journal entry, so it would be
Okay.
changing. So when we start the audit, we get what we call like the general ledger, the trial balance, and that's our baseline for the audit. So as we're going through the audit, if we as the auditors, because that goes back to kind of our role in the process versus management's, we're not part of the internal controls. So if we identify anything during the audit that would be significant, where we're like, you have to make an adjustment, a journal entry to fix this,
Okay.
those would be reported through that process, and we would identify them. And then we have discussions, do you want to make this, don't you? What's the materiality? But when we say that we didn't identify any of those, there was nothing from the numbers that we were given, that we were auditing, that were any corrections that were made that were significant or material
So-
corrections.
Ms. Donnelly could have a good night's sleep.
Yes.
Anyways, I want to turn it over to my committee colleagues, followed by the others in attendance. So Alderwoman Finlayson, do you have questions at this juncture?
She's muted.
Oh, you're muted.
Sorry. I do have a few questions. The last one, I'll start with Mr. Ostrowski.
Ostrowski. Yes.
Yeah. How long have you been auditing? You do the external audit for the city, correct?
Yes.
And what we're going to get from Ms. Dickinson is the internal audit. How long have you been auditing the city's books?
This is UHY's second year. So yeah, last year was our first year auditing the city.
Okay. Because I thought you were kind of new to me, and I've gone through many of these. We usually have an external auditor come in annually up until about 5 years ago. So anyway, my first question deals with the uninsured liability. Will we see how we stood over the last year, and are we making predictions for the future year? In the past, we have seen what we have utilized as far as being self-insured. We know how much it has cost us to be self-insured. And usually, I think we get a projection on what it's going to cost us to continue to be self-insured so that we can appropriately budget.
Yes. Yeah. I, as the auditor, generally don't get into any management projections. I can speak to what was presented and the procedures we performed around it. And again, we're kind of relying on the valuation and the assumptions. And we look at the historical data and just assessing an opinion essentially on the June 30, 2023 liability. But I'll defer to Jody to speak to any future projections or where that's heading.
So,
Well, before Jody speaks, will we see the projections up through June, not the projections, but the numbers through June 30th?
Yes, the June 30 numbers would be presented in that annual comprehensive financial report. And there's a liability line item on the government-wide financial statements that would kind of present that. And there's also the internal service fund that has that as well, and some disclosures around it, just describing essentially what that liability is, how it was calculated.
Okay, so we should go to the report.
Yes,
and
so in the
get-
report, there would be some information disclosing, nothing really related to future projections necessarily, that would be kind of outside of that, but as far as what's presented in there.
Well, we'll be able to see the trends so that we, as the financial finance committee, can look at the trends and see where we should be going. So anyway, okay. And GASB 96, how is that different? Is there a greater responsibility that we have for setting aside funds, or what's the difference there?
Essentially putting the subscription-based IT arrangements on the balance sheet. So before, they would have just run through essentially the statement of changes in your net assets, your income statement, as an expense. So now it's just moving the asset and the liability onto the financial state, or onto the balance sheet. So it's essentially booking an asset and a liability. But overall, no changes really in how you're paying those arrangements, how they're flowing through the income statement, other than they're booking an asset and a liability now. So net impact, not really much of anything. It's just now recognizing that there's some future asset from entering into those arrangements and the liability. So the asset is essentially the existence of the arrangement and the benefit you derive from having those IT arrangements, and then the liability is your future payments under that arrangement discounted to present value.
So what are the what's considered the IT arrangement? Is that what we're doing through our bargaining process?
Really procurement. So anytime you're buying, a subscription to any type of software application, you have to look at the contract and the arrangement and assess that. And if it's a long-term contract and meets certain criteria, you essentially, like I said, you book that asset and the liability. If it's kind of a short-term, it's only like a 12-month, or there's not the contractual requirements met under the standard, you would just keep expensing that as you have and wouldn't put it on the balance sheet, essentially. So again, no real net change. It's an accounting thing that they want to recognize all these assets and liabilities now for things that are contractual arrangements. And it was the same thing with leases. A lot of that wasn't on the balance sheet. And under GASB 87 last year, you had to go through a process of evaluating all those lease contracts and book an asset and a liability. But generally, the asset and liability are the same. So it kind of results in a net zero impact, other than they just show up on the balance sheet. So when you see the balance sheet year over year, if you look at last year, you won't see there will be new line items for these subscription-based IT arrangements.
I can give you a couple examples of things.
Could you introduce yourself?
Oh, sure. Julie Donnelly, Assistant Finance Director. So the things that we were looking at were like our software that is for the telephone service. So that's a piece that kind of ran through the whole thing. Some of the police equipment has software associated with it, so we put that on there. The biggest ones have to do with like budgeting software, anything that we enter into an agreement for greater than 1 year. So it's pretty broad. But I just wanted to jump in.
I'll add that this is an attempt by the Governmental Accounting Standards Board to say we have a lot of these IT arrangements for software, and we pay annual cost for them. Some of them are a long-term nature, where we have basically committed to something that's sizable and something that's longer term, and that we're not likely to get out of. And what it wants to recognize is some of these things you're paying every year are longer term commitments. And so it treats it sort of like debt and like long-term leases, where it says you've got a long-term commitment to this company to pay for this software, but then it offsets it with an asset because you actually bought the right to use their asset for that period. So that's why it goes on to the balance sheet as an asset and a liability. So there's no real net impact, nor does it change how we pay the bills to these software companies. It's just showing you long-term liabilities are out there, and this is the value of those. It acknowledges the long-term relationship we have with the vendor. And Julie's examples were a couple of the larger ones that were longer term and larger.
Okay, I understand now, and I appreciate that. And it really is about those IT agreements that are in place and going forward. So thank you.
Alderwoman O'Neill? You're good. Is there anyone in the audience that has a question at this time? Kaylin? No, we're good.
Jody.
Oh, Director Dickinson.
So Alderman Finlayson's first question was about the self-insurance liability. And I wanted to give you some background that I don't think we've covered yet. When we're getting ready, we pay workers' comp claims and general liability claims all year. And at year end, we have the Office of Law and my risk manager look at all the open claims and evaluate them and try to provide estimates of where we think we're going to pay out money, whether it's settlement in those cases or the cost of defending each claim. And then we take that total and we send it to the actuary. And the actuary uses that information, tries to project over what period of time these claims would be resolved and therefore settled, and also looks at the part that Jason was talking about, the ones that are out there that haven't been, the claims that haven't been claimed yet, the ones that haven't even been, that aren't even on our radar yet. Tries to make a projection on those based on our past history. So all those elements go together to calculate an actuarial liability for self-insurance claims. And what you see on the balance sheet of the self-insurance fund, which is at, I should call it, sorry, it's not a balance sheet anymore, it's a statement of net position.
Net position.
It's on page 114 of the ACFR, and it's in the self-insurance column, and it'll be liability claims, and there's probably a short-term piece and a long-term piece. So that's where we present it. And he also mentioned that there's a footnote in the notes to the financial statement that talks about the liability, what it means, and what the value is.
Thank you.
Thank you. Do you define long-term versus short-term?
Short-term is anything that you expect to pay out the door in 1 year after the date of the balance sheet.
Okay. Thank you. Okay, you're on for, and just for the record, I just wanted, because our Office of Law, our city attorney is in the audience. As soon, I believe probably because he heard the word self-insurance, so I just wanted to recognize him. Thanks.
So I know that the studio has this presentation. It would probably be better if they put it up on the screen, and then I'll tell them when to advance the pages.
Yeah, we need it on the screen. Which one, for clarification?
It's got a dark green color slide. It starts with City of Annapolis, FY 2023 ACFR review. Do you have it up, Julie? Can you see if you can project it?
Is it attached?
You have it.
Yeah,
we may be able to get Julie's laptop working here and put it up on the screen, because he did plug her back in.
TV's asking for the file, the name of the file.
Yeah, what is the name of the file?
ACFR FY 2023. There it is right there. Thank you. So I sent this in an email last night, and with it was the ACFR itself and the letters that Jason was referring to, just so you would have those in the top of your inbox to refer to today, but I neglected to send the other PowerPoint, so that was my fault. So some of you saw the presentation that we did to the FAC, the Financial Advisory Commission, a couple days ago. I changed this a bit to more fit. Jason did the part about the audit, which I tried to cover at that meeting. And so this has got a little bit of new information, but a lot of the same topics. And when I would like to clarify that we did not do an internal audit. This financial statement we pulled together, then the information was audited by the external firm, but I'm giving you some highlights as to what's in the document and what it shows. So there was no second audit done. I didn't do any additional procedures. And I don't want to neglect to say that this audit and the creation of this document is mostly due to Julie's hard work, because she really took the reins on this year, and it's the first year that I've just been able to pull back and do other things. So kudos to her. It's quite an effort. Yeah. And along with the last 2 years of having those new GASB statements on leases and subitas to look at, it's not an easy process. As you can imagine how many agreements we have out there that have to be read and analyzed. So it's a lot of hard work, and she's worked very hard. So this is her document.
With no material weaknesses.
And no, yeah, and all those things about the clean opinions and stuff, that's due to her good work. And it's not that we didn't, as we pulled the numbers together, sometimes we find something that needs to be fixed, we fixed it before it went to the auditors. So it's not that it was perfect from the start, but we find things along and we change them before we finalize them. All right? Okay, so slide 2. Jason covered some of these. We have introductory sections in this document. That's got a transmittal letter in it, the GFOA certificate, org charts, and a list of principal officials. It's just some general information. In the financial section, which is the most important section, it starts with the auditor's report, runs through all the basic financial statements. Then we have the notes to the financial statement, and that required supplementary information. And I don't want to ignore what I feel is the most important part. The management discussion and analysis is a document just after the opinion, and it talks a lot about the what happened during the year, what went up, what went down, what the trends were, but it's not only supposed to address the trend, but what caused the trend, what happened in the city's operations or community that caused that. So it's supposed to discuss that information as well.
Page 11, okay.
Yes,
If
that
you-
is, yeah, page
yeah.
11, and I find it, from an overview, it's a very useful tool.
Yeah, okay.
And if you want any information on details about debt or details about the pension liability, you can go to the notes. They're very descriptive, and so that gives you a lot of background on how those numbers were derived and what are the components of each number that's on the financial statement. And then last but not least, in the back behind the required supplementary information, we also have some combining and individual fund financial statements, and that's where you'll find all the budgetary information that the council follows along with to see how the funds are managing with the appropriation authority that you provided.
That's starting on, I'm doing this just so to
Yeah.
help people, but it's.
Page 85, that, yeah,
okay.
that starts on page 85, and it gives you a detailed general fund budget breakdown, and then each of the individual funds that have a budget established are behind there in order. All right, and the last part is the statistical section again. So can you advance the slide? Yeah, we talked about this, the fund level statements, what's in the fund level statements, covers major funds versus non-major. It reconciles that set of statements to the government-wide statements. And it gives you the breakdown there of the fund types. Okay, go to the next slide. All right, so, yeah, like I already covered this. Next slide. I'm jumping ahead of myself here. The statistical section has information, and it ties to do 10 years of comparative information for a lot of this information. That's where you can see general financial trends over time. And it's got some revenue capacity information as well, some debt capacity, and then some demographic and operating information. Next slide. All right, so just to give you a few highlights of what you'll find in the financial results here, we have an increase to our government-wide net position, 19.5 million for governmental activities and 2.8 million for business-type activities. Those business-type activities include all of the enterprise funds, utilities, sewer, water, watershed restoration, refuse fund, parking, and the transportation fund. So those are all considered enterprise-like businesses, and they operate like businesses collecting fees for their services. The fund balances increased in the general fund by $716,000. The capital projects fund increased by $17.7 million. And the proprietary funds, which we just spoke about, by $2.8 million. The capital project is a significant increase, but we have some debt proceeds for City Dock that we issued, which caused that increase, as well as the concession payment that we deposited in the City Dock project. So that's the primary cause of that. And I'll just ask Julie if I forget something, chime in. What's in these numbers? All right. And the P3 is another financial highlight for a year, as you know. In FY23, the garage was finished. We had a $30 million addition to the fixed assets in the parking fund, and as well as the debt that was issued for that, the refinancing of the sub-debt, which we did after we closed on, after we finished the garage. All right, so we purchased Cars Beach, as you all know, using a POS monies from the state. That went onto our balance sheet as an asset. We issued $34.4 million of debt for ongoing construction, I mentioned that, and refinanced the sub-debt. We were able to, because of the positive results in the general fund, we were able to replenish the reserves that are in the general fund. We, had a balance, we used some, we added back. We're close to where we were the year before. And then we have unspent ARPA at June 30, 23 of $6.7 million. Next slide. Okay, now that's not really legible because it's kind of dark. But this is just showing you where the reserve balance is, where the first column is where it was at 22. It shows you what was left after the 22 uses. Then it shows you the new layer that we added in 23 at the end of the year due to the results, and the final balance of the reserves at June 30, 23. And then I tried to give you a look at what was programmed for use in 2024 so that you can have an idea of what's not yet committed in those reserves that's carrying forward to the end of the year. And I apologize, it's dark coloring. I couldn't figure out how to make those numbers more visible. All right, next slide. In the general fund budget, we have two budgetary presentations in the ACFR. The first one is very brief, very summarized version, which is on page 81 of the ACFR, and the more detailed breakdown is on page 85 and 87. So you will see, if you look at those statements, that revenues for the general fund exceeded the budgeted expectations by $2.3 million. That was mostly caused by better than expected interest income and an increase to our estimated income taxes of about $2.5 million. Now, those increases were offset by other decreases, and there were some variations on the other items as well, and you can go to those pages that I referenced and see what the increases or the over and under budget amounts were for revenues. And I just want to comment on the interest income along with the increase in the interest rates that benefited us to this extent that the rates were going up on our primary investment account. On the general fund expenditure side, expenditures were less than budget by $6.96 million, and $4.5 million of that was in public safety departments. And if we can go to the next slide.
I'm sorry, could you repeat that?
All right.
That last sentence you just said about public safety.
Yeah, so the total amount that we underspent our general fund budget by was $6.96 million, and $4.5 million of that underspending was in the public safety, police, and fire. Okay. So On the next slide again, I apologize. I don't know if there's any way for them to brighten up that slide or change that to make that more visible. But hopefully you have it in front of you so you can make out the numbers. This just gave you a breakdown. I didn't put this in the facts presentation. I was trying to keep that more high level. But this is a breakdown of the expense side and which departments were, every department's under budget. The only thing that you see that's showing over budget is the debt service, and that's because of those lease and SBITA entries that are recording an interest expense that aren't truly a budgeted expense. So I don't know if you want to take a minute and look at the numbers and formulate questions or.
Yeah, we have some questions. Alderwoman O'Neill?
So when it's underspent in the budget, that's staffing?
Sometimes, yes. Most of the time, yes. And I will say on the police side and the fire side, most of the savings were in the salary and benefits grouping, especially on police. It was the primary, as you can see, the 3.2 million primary cause of that, and fire had 1.2, which for the size of the fire department isn't as notable. And then most of these other ones, yes, like from my department, yes, it's vacancies, not having staff, and likely the cause for most of what you see there. We do underspend on our non-salary items as well. If they're going over on one of those, they're supposed to come up with funds from another line item to cover them. But at the end of the year, they will liquidate any purchase orders that they didn't need, and typically have some left over in their non-salary line items. But the majority of it's coming from the salary and benefits vacancy savings.
And are we seeing a similar trend for this year? Have you paid it?
So yes, up until the last time we looked at it, which we're doing some projections. We did some projections as we went into union negotiations. And yes, I saw that on the police and the fire a little bit, but not as much. And throughout the departments. But on the police side, they've just been hiring recently several new officers. So I don't know what that's going to look like projected out to the end of the year. And as you know, when we established that budget, we actually put turnover savings in there because we know they're going to have vacancy savings. So this, what you're seeing, is over and above what we already anticipated.
Okay, thank you.
Could I just, on that subject, when you say savings, we have to be careful, isn't that, we have to be careful, it's uncommitted.
I don't want to make it sound like a good thing. It just means we thought we were going to spend this and we're spending less because we can't get people to come fill the positions that we have, and that's not a good thing.
Yeah, it's I mean, I would call it uncommitted money.
Yes, uncommitted funds. We're trying to fill positions. We'd love to be fully staffed at all times in all of our departments, but it's not happening now. And I think that trend, and I'm sure Jason has seen it at his other clients, that trend is across all employers, I think, are struggling to draw in employees.
Yeah.
I know it is on the government side. Everybody's struggling.
Yeah, it sticks out, like, for lack of a better word, sort of like a sword. It sticks out on like page 87. You see it as, you just want to make sure that people don't see it as a savings, but uncommitted.
Right.
Okay. Alderman Arnett.
Thank you, Madam Chair. So I think this is interesting. I think your statement that this continues on in the current budget, I have to note that we have been presented a contra picture, particularly from fire at city council meetings, and I find that hard. We're still ISO rated #1. We're still giving them more money than they're spending, and I wish someone, well, you have given these data to them in the union negotiations, so I'm not understanding the picture of complaint that they're presenting to us at the council.
So.
You don't have to justify their
That's
position.
okay. It's just, there's so many issues woven in there that some of the efforts that they've come to you with as concerns are, how can we fill positions? What can we do to make it easier? Some of the issues, I believe, have to do with how many stations we have, how many shifts of firefighters we have. So it's a multi-layered issue, and you can throw as much money as you want to at salaries, but if you can't get anybody to come, they're not going to spend it. So we all hope for the day when we can have all of our positions filled. And I don't know if Vicki wants to add any more to that.
Yeah.
Perhaps if we go back to 3 shifts, then it'll be easier to come up to full staffing.
Yeah, I wasn't going to add anything. Obviously, we're still in negotiations, so I just kind of want to honor the boundaries of that discussion.
Yeah. Understood, yeah, but it is an important point to be made to the public, just to sort of simplify it. You know, we have not defunded the police, we have money in there for staffing, and it's, you know, we have to be very clear about that. Alderwoman Finlayson has a question.
Thank you, Madam Chair. What is the date of the this document? Is this a snapshot of year to date?
So no, I'm representing to you here what the budget amount looks like for FY '23, which ended June 30th, 2023. So it doesn't project for 2024.
Okay, so the under expenditures, I'll call them, are actual, you know, we don't have a portion of the year yet to expend these funds.
Correct.
Okay, so this is our fund balance as of July.
So, I wouldn't call it fund balance. What this shows is that we received a little bit more revenue than we anticipated, and we spent less than we had anticipated. And in accordance with our policy then, at June 30, we take that excess, and I'll call it savings, not a good thing, but savings, and we put it into our fund balance tiers. There's an unrestricted portion that gets the first tier. That's got to be brought up to a certain amount. The budget stabilization fund has to be brought up to a set amount. And then we distribute the rest into the capital reserve fund and the reserve for one-time uses.
Okay, thank you. I just wanted to be clear that that is as of 2024 or 23.
No, FY fiscal year ended June 30, 2023. And I know it's now, 9 months past that date. So we're now working on projections for 2024 to try to see where we're going to be this year, and then trying to set up our budget for next year.
Yeah, that's an important question, just for the data date, for people that don't know. Thank you, Alderwoman Finlayson.
One other question. Transfers out, 52,000. That referring to?
So that's, the transfers out are our budgeted transfers to other funds. And that most of that amount is going to be the transfer out of the capital reserve fund to the capital project fund to fund some of our ongoing capital projects. There are also transfers to fleet, the fleet replacement fund, and Julie will help me here.
Yeah, and those are just, the overage there is just a result of, it was one or two big ones to fleet, where something was paid out of the general fund that is actually capitalized in the fleet fund, so we transfer the resources.
Okay, so it's all in-house, though.
Correct. It's just two other funds.
Thank you. That was my question.
Thank you. Anyone else? Kaylin, we're good? Okay, you can continue, Director.
Okay. If we go to slide 10. Okay. So this is, again, some of the highlights for the year. We talked earlier about issuing the bonds of $34.4 million, and we issued $8.2 million Series B debt. That's what we used to refund the sub-debt. The refunding resulted in $15.2 million of present value savings, so that's why we undertook that effort. We talked a lot about the leases and the SBITAs, and we talked about that enough and talked about how it affects the balance sheet. So, but that was quite a big effort from the accounting standpoint of analyzing all those. On the pension and OPEB liabilities, we saw growth in the markets comparing our 22 year end to our 23 year end. And so we had a growth in the net positions of our police and fire pension of $11.4 million and a $2.1 million growth in the net position of the OPEB trust. And when you're looking at the pension results, you look at the net pension liabilities. Our police and fire net pension liability went from $65.4 million to $68.7 million. And that the funding ratio, though, for the year, which means how much of that liability is funded with assets, went from 73.9 to 74.1. It's not a big change, but it is moving upward. On an OPEB trust, we have an OPEB liability of we went from 34.9 to 26.8 for the net pension liability, or net OPEB liability. So that's a good sign. That means that long-term liability is decreasing. And the funding ratio went from 25.3 to 31.6. And I think one of the reasons we're having success there is because we, a few years ago, limited who can enter the OPEB plan. And that topped with our continual funding of the trust has been building up those assets. And on the state pension liability, it went from 20.4 million to 26.7 million. The ratio for that pension went from 81.84 to 76.27, but I have to remind you that the state pension reports that go into our ACFR are 1 year behind. So they're actually reporting FY21 to 22 year end, which, as we know, that had a downturn in June of 22, there was a downturn in the assets. So that's one of the reasons you see that trend there.
Just for clarification, the acronym OPEG is Office Post-Employment?
OPEB?
OPEB.
Other Post-Employment Benefits. Okay, it is basically, for our purposes, it's the health care that the city pays for after somebody retires.
Thank you. Alderman Arnett.
Thank you, Madam Chair. To our auditor, can you tell us how these ratios compare to our peers at either municipal or state levels? So, for example, 74% funded for police, 32 for OPEB, and 76. How are we compared to our peers in the rest of the country?
They run the gamut. So there's a wide swath. I mean, I've spent a lot of time doing pension work. So yeah, I mean, if you're above 70 is always a good barometer. 70, 75%, 80% funding is pretty strong funding relative. Like I said, there will be plans out there 90, 95%. You know, I think the average overall for pension is probably trending around 70%. OPEB is significantly lower. There's unfunded plans out there that are complete pay-go still. So, you know, the fact that you're funding it and the funding percentage is going up and the liability is going down, I think that, again, it's a lot of it's trend. So not even point in time necessarily. You want to look at the trends and kind of directionally where you're going and what the objectives are. So from the OPEB standpoint, even having a 30% funding, I think is is pretty solid relatively.
So in terms of our bond rating, these are pretty healthy numbers that would help us maintain our bond rating?
I'm not a bond rater, but I think that would be the kind of the overall environment. But yeah,
I'll state it a different way. My takeaway is that this helps our bond rating, that we're above the peers, our peer group, or at least in the top echelon.
So I would say that's, yeah, that would be beyond his expertise and my expertise to say that. I'd say if we are staying in line with our peers, that's a check in the positive column when they do the analysis, but that checklist is so long and considers so many different things that it's hard to say if this alone would impact that in any positive or negative way. They have some very complicated calculations that they go to look at how much debt we have, and they have their own ways of measuring it that are their own methods, and if you don't meet their criteria, you can't move, or you won't go down, but you won't go up. So it's a complicated thing, and it's not my area of expertise. When we have Davenport in here, they may be a little bit more knowledgeable about what's going on out there with the ratings and the rating agencies, so we'll remember that when they come to do their debt affordability review. I wanted to add about the OPEB. This is a trust fund that we're putting money in, but we're not paying any benefits out of it right now because it's still what we would, in its early stages, and until we get those assets built up to a much higher level, we won't start taking the healthcare cost out of there. So it's building, building, building. If you looked at this trend overall, you're going to see it going up, but it's a few years away from a well-funded plan yet.
From a what?
Well-funded plan.
Such as?
I remember that, I don't remember the number, but our actuary, Greg Stump, had an amount, he said, until you get to, and it might be up around 60 or 70, that you don't start paying your cost out of there until you're at that higher level. I know it was at over 50%.
Thank you. Anyone else? Oh, Alderwoman Finlayson.
Yes, to follow up, so how are we paying those retirement health care benefits? Is that coming out of the, well, that's my question.
Yes, so I will say that right now we're paying the retirement health care on a pay-go basis, and the general fund covers the most of that. The employer piece, remember that anybody who retires with us, they can join OPEB, but sometimes they have to pay 100% of their health care. For those that do qualify for an employer piece of the cost, we contribute towards that. But every retiree is paying a portion, and we are using their contributions to help fund that, as well as our own funding from the general fund, which is, I think it's in the neighborhood of $1 million a year towards that effort, towards retiree healthcare costs. On our part, that doesn't include the contributions from the retirees. And I think that we might be able to see that in the OPEB statements here on page 120. There's a statement in there that will show the benefits coming out, or the cost. We move all of the cost over there and present them in those columns. So, what did I say, 100 and...
But I think, Alderman, our next questions can be answered on page 65 on the liability.
So that means that we can see the OPEB cost coming out of the general fund.
Mm-hmm. Yes, and so, like I said, on page 119, there's a presentation of the pension fund activity and the OPEB fund activity, and we have moved all contributions to that effort into this fund and all the payments into this presentation. So you'll see there the deductions include the payment of benefits and admin expenses, and then you see the contributions coming in from the plan members and from the employer.
Thank you.
So that's $2 million.
Okay. Oh, continue, sorry.
Oh, okay. All right. So I think we can go to slide 11. Do we have any more questions on that? Okay. On the utility funds, the sewer fund, we saw an increase in its net position, 1.72 million. The water fund, an increase of 983,000. Watershed, an increase of just 15.7. On the refuse fund, oh, huh? 12, please. I'm sorry, I did see. What? Oh, I know what they did. I'm sorry. They're off one from mine because I think when they changed. Never mind. The slide numbers are off a little, but on the utility funds, we have these increases to the net position. And on the refuse fund, there was a decrease to the net position, but it still ended up the year with a net position of $2.38 million. Okay, I don't know if it's me off or them. All right, on the next slide, parking and transportation. Off-street parking fund, and this is good news. Despite the closure of the Hillman Garage during the year, we still had a small increase to the net position in that fund, 253,000. What we found was although the revenues were down a little bit, the expenses were down as well to compensate. And we were able to send the full subsidy to the transportation fund. On the transportation fund, their net position increased by $545,000.
That's huge news.
Yes, that's nice. And mainly because the parking fund could send over the full subsidy, because during the pandemic, we had a problem with that and had to supplement the transportation fund with some other ARPA and CARES money. So we were able to do it ourselves this year without tapping that. So the next slide. Okay, on the internal service funds, we talked about this earlier, the self-insurance fund. The claims liability increased substantially. We've had some recent cases come to light, and went through our reserves very carefully and make sure that we had adequately reserved. And I can say the reserve doesn't necessarily mean these are settlement amounts. It's that the cost to defend some of these suits is considerable. So that rolls into an increase in liability. And as a result, in the self-insurance fund, it had, instead of a positive net position, it had a net deficit of $3.5 million. And I mentioned this in the fact we need to, this will result in the actuary saying we need to contribute more, which we will, but I'm also contemplating making a contribution to this fund in this fiscal year to try to offset some of this large deficit.
But we should not be using debt to fund debt. I mean, is that what we're trying to prevent?
Right, we're not. This is just, we recorded the liabilities, so we're recognizing that the cash that's sitting in the self-insurance fund is not enough right now to cover these liabilities. And since that contribution comes from the general fund, we may want to try to offset some of this year and then into next year. Normally, we would, when an internal service fund runs into a deficit situation, because it only serves the funds of the government, you have a couple of years to try to remedy that, but you do need to try to remedy it, because what it's reflecting is there's a liability over here in this other fund that's going to have to be funded by the government's general fund or other participating funds.
And you list that as part of the risk management section of the report.
The risk management section of what report?
What's that? In the act or the self-insurance?
Yes. Yes, we talked about the claims listing and coming up with the claims liability, and this is the result of it. Since I've been here, that number has gone up and down and up and down. Sometimes we're able to reduce our contribution substantially. Sometimes we have to kick in, but this is the biggest change that I've seen since I started here, but that doesn't mean we can't remedy it. We just need some time to get some funds over from the general fund to try to bring that down.
And we'll do that fiscal year 25 budget.
We will be increasing the 25 contribution. We always use what the actuary recommends, and they did increase their recommended contribution, but that wouldn't necessarily negate this whole deficit. So that's why I'm contemplating try to find a source to do some of this year, maybe with some of our one-time monies, so we can try to get it back into a better shape.
Go ahead.
And you may see in a year, some of these cases will settle for lower, and then we can reduce that right back down again. So it could change to a more positive number by the end of '24. On the health insurance fund, just to note that the results of '23 are not going to allow us to offer a premium holiday to the city and to the participants. We've been able to do that in the past few years because our health insurance expenses were not as high as we had anticipated. And the way our policy runs, if we have an excess amount in that fund, we try to somehow return it to the participants and to the city because it's overfunded. But this year, there's just enough in there to meet the 10% threshold, and so we won't be doing a premium holiday this spring. On the next slide, I want to thank the studio for changing this to white print, because now everybody can see the numbers, because online it's still the black type. So FY24 has been a good year so far with the general fund. When I did my projections a few weeks ago, we were seeing revenues ahead of budget and expenditures savings again. I'm looking forward to reevaluating those, see where we're at now, but I haven't had time to do that. If you look and see where we're at, this gives you a picture of '24, our adjusted budget and what we were projecting when I did these a few weeks ago. Total expenses of 106, but of those, 6 million of those are coming out of the reserves. So the recurring expenses are just under 100 million, and we have recurring revenues of 103.7. So these projections would tell you that 3.92 would be going to the reserves. But like I said, those are early projections, so I expect these to change somewhat. Next slide. This is my last slide. Just to talk through some more challenges. Additional contributions to the self-insurance fund. We just talked about that. We're going through union negotiations for 25 and 26, and those are not completed yet. Hillman Garage is open. I've only had one. We're all depending on that waterfall payment to come, and we've got one in, which was about $2 million from the operating side. And so we're going to see how that goes going forward, so we can try to get a good measure of what kind of money that's going to bring in over time. We are going to need to monitor our revenues. We've had a significant increase to the tax assessments. As anybody who lives in the Annapolis area knows, this 3-year assessment, I think we measured like an overall 7% increase. And some of the property values went up significantly more than that. So I don't know what's going to happen on the abatement side. In times like this, many of the owners would go back and try to dispute their assessment. So we'll have to see where this falls out after the year progresses. On the positive fund balances and our ARPA funding, we're going to have to carefully consider during the budget process what we do with those, because the ARPA money has to be committed by December. So we're looking at all options, and we'll present the council with our recommendations in the budget. All right, that was a lot of information, so let me just give you a minute, see if you have any questions to follow up.
I know, are you going to go into more detail on the ACFA, or?
No, that's all I was doing, trying to do highlights and where our net positions were
Sorry, my mic
overall,
was
but if you want to dig in more, we can.
No, I mean, no, I just have a few questions, and then I'll turn it over. My focus is really risk management, and I'm speaking specifically of your notes on risk management. And one of them, of course, is the Hillman Garage and City Dock Public-Private Partnership. And this is a question to the auditor. We had proceeds of bonds to sort of refinance high-interest bonds, I think, from my understanding. And my question is, on the process there, did you review that process? Specifically, I think, as described in note 13 under risk management about the bonds, and is there any concern of yours on how that payment, was handled and such?
Yeah, I mean, we had, just from a financial reporting perspective, we had a lot of discussions about how to present that and report it. It was certainly a complicated transaction, made further so by the refinancing.
Yes.
Correct me if I'm wrong, but most of the impact was, the debt's now on the books, the garage is reported as an asset, and then the net of all that is reported in a line item called a deferred inflow. And essentially that's going to get amortized and expensed over, would that be a revenue? Because it's a deferred inflow. I think that would be an addition.
Yeah. It'll come in. It's recorded on the, here.
Yeah, so page 29, there's a $21 million deferred inflow related to the garage. And really that was essentially reporting the garage as an asset, but then netting it against the debt that was issued. So that's kind of the 30 million minus the debt gets it to the 21. Part of the PPP standard and the guidance for accounting standards related to the future payments, there's nothing reflective of that right now in the financial statements, and it has to do with the agreement and the certainty of the payments. If there was some kind of arrangement that you knew what those were going to be, you could book that as a receivable. But as it kind of states up there, it's unknown right now, so there's nothing reported from that perspective. But obviously, there's going to be future payments associated with this. So really, from a financial perspective, that's what we looked at it. We looked at the standards. We went through a lot of discussions about how to present it, what disclosures are required. So we evaluated it from that perspective, from a overall risk of paying the debt and all that. We don't really get into that part of it in our role. We're just essentially looking to say, are the financial statements reported in accordance with GAAP? So we did go through a lot of discussions. It's an interesting and complicated transaction. So certainly got into the GASB, the Government Accounting Standards Board, those standards related to that. And it's all presented accurately as presented in the financial statements.
It is a 30-year, I shouldn't use the word experiment. It's a 30-year experiment, but you know that, and you will be following this as we continue.
Yes, so the asset will get depreciated, so we'll look at the depreciation every year on that. We'll look at the amortization of the debt.
Yep.
And then, as was spoken to, there's going to be future collections related to that, and we'll look at those revenues whenever they come in, and we'll audit those and test those. But as of right now, there's nothing reflected from that perspective of the future receivable. And again, that just has to do with knowing what those are going to be.
Julie knows I'm looking for a graph in the next report. Sorry. And the American Recovery Plan and the money left over, could you just give your comment on the way we have spent it and what's to be spent and any exposure in that?
How much is unobligated? I don't know what the unobligated amount, but it has to be obligated by,
The end of this year?
yeah, the end of this year and spent by 2026, I believe. So, I think most of that to date, I think it was spoken to earlier. I'm not into the details, but I think that was for transportation, correct?
So we have our general city monies that at the end of this year were $6.7 million, which includes the original deposit plus all the interest that we've earned on that. We also had substantial amounts of transportation ARPA and transportation CARES. And even on the single audit that they did, I believe their only major program testing was the transportation ARPA, because the transit department used transportation ARPA to cover some of their FY '23 expenses. And that was our major program because it was substantial enough. And I think it was the only one. And so they detailed tested those transactions to make sure they were in accordance with
And that
the
doesn't,
ARPA requirements.
that wasn't considered in the calculation of supporting the transportation fund?
No.
Right.
Well, it was, no, I take that back. So if you were to look at the transit fund and their expenses and their revenues, within their revenues, part of their revenues was drawing down from the state ARPA allocation that they had. So that did help them through the year. Plus, they have some left for this year that they're planning on depleting. I don't know, Julie, if you remember what the amounts are that they have left to use against the FY '24 expenses, but their CARES allocation, they don't have it in hand. Like, we have our 6.7 million in hand right now.
Yeah.
The state isn't releasing those ARPA funds until they spend them.
Yeah, there's, it's just over 100,000 in ARPA for transit, and then the CARES is much more significant. I think it,
That they have.
That's a scary way of doing business. We wait for you to spend it and then we'll pay you.
Yeah, they depend on our cash flow to keep things going here.
And then last but not least, when you look at, I forget what you call it, the IT, you sort of categorize all of that, IT expense, where do you do that? I think you have it under part of the risk analysis.
The subscription-based IT arrangement footnote.
So
I think there's a separate footnote for that.
Well, you have to do a lot of monitoring for GASP, a lot of additional controls, et cetera, to meet the GASP standards.
Related to the subscription-based IT arrangements?
Yes, that.
Yeah, I mean, we're looking at management's process for
Right.
capturing them. We're not really testing the controls related there. We are testing the balance. It's not really a extremely material balance. So, it was something that we did spend some time testing, given it was a new standard. But really in the implementation, we're looking at and Julie went through a very extensive process of capturing, and as you can imagine, it's kind of going through the general ledger, identifying what expenditures would possibly qualify as like IT arrangement, and then had to reach out to the various departments, get the agreement. So we kind of evaluated and looked at what process Julie went through, and it was a very thorough process to identify those. And then once we got to the point of, some of them were really de minimis and didn't even get recorded under that arrangement because they're just immaterial. But ultimately what got reported, we went through the process of evaluating the contracts, looking at how the calculations were derived, how that liability and asset was calculated. So we looked at kind of as our walkthrough process, what process that management went through, and then ultimately what was used to record them.
So it hasn't reached the standard, it hasn't reached the level of it being sort of an unfunded mandate, if you will. That's sort of what I was getting at, Okay, so we must have other questions. Oh, I can't see, but I think Alderwoman Finlayson first, followed by.
They can take the presentation down until unless we want.
PowerPoint down, there you are, okay. Alderwoman Finlayson and then Mr. Cardillo second.
Thank you. I think you just answered my question. Of course, I'm always asking and concerned about transit and the transportation fund. So I went back to look there with the additional funds that came in through off-street parking. Transit is doing okay. They're not additional revenues needed for them. Is that correct?
That is correct. And so far, I just qualify that by saying we're going through a time of transition where eventually the transportation cares and ARPA monies will be gone, and we'll be getting money in from the waterfall, and we just have to make sure that's enough to sustain transportation. So I've only gotten one payment through the waterfall, so I don't really have a history or a pattern to try to estimate how that's going to impact us long-term.
Okay, thank you. I just want to make sure we keep that in front of us. And I think you answered the question. All the ARPA funds have to be at least designated by the end of 25 and used by the end of 26.
Yes, and that's calendar 25, not fiscal 25.
I think it's calendar 24, right?
Well, I'm sorry.
24.
Fiscal 25, obligated by December of 2024.
Mm-hmm.
But we have then, after we obligate it, we have 2 more years to spend it out the door. But we do have to have a documented obligation by the end of December.
Okay. I look forward to the recommendations. Thank you very much.
Mr. Cardillo? Jim?
Thank you. Thank you very much. One question for Jason, one question for the finance director. Thank you, Jason, for the presentation. You mentioned early on, and I believe that Alderwoman Tierney mentioned the required communications letters, and you had indicated that there was a prior recommendation that was implemented in the current year. Is that correct?
Yes, yeah. Last year there was a material weakness related to construction in progress.
Okay.
And
that was addressed.
Yes.
And then there was a supplemental recommendation regarding SBITA about how to go about, what to look at and how to go about, which it sounds like that was addressed as well.
Yeah, and that was more just highlighting that it was new and
right.
to put a process in. And as we discussed, it was very thorough, and Julie can attest to that.
Yeah. So no, I think it's fantastic. So we didn't have anything that warranted, or use the word disclosure or notification to management about you should be concerned about this. You should be concerned. Nothing in the current year being audited, FY23.
Correct.
Thank you. Thank you very much. That's really good news that you go from where you were last year. And thank you. Thank you. And then one question for Jody. I should have asked this last week when we were in the meeting, but you indicated your budget challenges for the upcoming year are one of them was the potential for appeal of property tax assessments.
Right, so yes. The reason is that the assessed values went up so much for these upcoming property tax bills that usually results in a lot of people trying to fight those increases. And I don't know how that process works at the state, and if they have to pay and then come back with some kind of credit if they get one. But that's just something we want to keep our eye on, because with such a high increase, you're probably going to see more protests.
But what do you budget for potential property tax revenue?
So so we got from the state the July 1, 2024 assessed values for each property, and they gave us the 3-year
phase in.
Yeah, that phase in 3-year values. And then we used that to determine times the rate, times our property tax rate. But then we also have to try to estimate credits. We also got from the state this year the value of our homestead credits under the new assessed value, because that's capped at 10%. So they gave us those homestead credits, and we had to just do some estimating for the other tax credits that are a part of our credit system, whether they're state or county or local, and then come up with our estimate that way. And that's how we got to what we think is maybe 7%.
Okay,
As best we can
so
tell.
So the best estimate right now is a 7% increase in property tax revenues for the upcoming fiscal year,
Correct.
which may be impacted by appeals.
Maybe, yes. And I don't
Okay.
know how that's going to go. And
But
we
the
don't.
7%.
Yeah, we try to be very conservative too when we're making these projections, so.
Right, when the
Um,
assessed value of the properties goes up far more than 7%.
From some properties, I mean, I think it varied, and I don't.
Yeah,
know
I
if
don't, what was the
inside
average
city-
increase?
I don't.
Doesn't the state provide that data?
I'd have to go back to the listing and see what the average increase was. I think I calculated 14.
Okay, so it would appear that
So we
it would
have,
appear that the appeals is a less significant impact on the budget than the overall increase in potential property tax revenues.
yes, I hope so.
Okay, thank you. Okay, thank you.
So you basically, in short, you know that there will be appeals, and you put in some figure assuming the same as like last year? Is that what I'm hearing?
No,
or no?
so this is, I wouldn't say that we tried to quantify, because I don't know that this has ever happened before. There would be nothing to compare. The last time that we had a reassessment,
Yeah.
I think the values only went up a total of like 7.5%, and that was phased in over 3 years. So the increases were much lower and would not necessarily exceed the homestead cap. So trying to seek an abatement would be less successful, I would think. But, how do I want to say it? Not as much cost beneficial to the person, but if it goes up a significant amount and it's over your homestead, I mean, if it's up around 10%, your homestead cap, you might be more inclined to say, I need to do something, you know, I need to protest this. I don't even know if they could, I don't know what the process is. I don't know what the considerations are by the state when they handle those.
Yeah. I'm trying, there's a word for that I was, and help me with this, Jim, it's sort of like what the transportation department says, okay, we're not gonna get all of the revenue for ticketing because of the appeals, and there's not that procedure in evaluating property tax.
So I won't say that there's, okay, I'd have to tell you, I'd have to go back and look at our calculation. We were very conservative in the way we estimated credits.
Okay.
We don't have access to all the credit information, but we were very conservative with those estimates.
I think that's all.
So I'm hoping that we were conservative enough with those.
Yeah.
Did not specifically try to estimate abatements.
Okay. In my category of just sort of risk analysis in the ACFR, I just was curious when you projected, made projections for OPEB, your escalation rate was 2.25% in your calculations, I believe.
So I don't,
And
you have to tell me what you're referring to, 2.25%?
Just with the flux and the effort on reducing escalation and where it is now and the different reporting of such, are you comfortable with the interest rate that you are using in the report, specifically on page 57 under the benefit plan? Is kind of where did you come up with that number because of the federal policy sort of still in flux on reducing escalation?
Okay, let me look at what you're looking at on page 54. 57.
Yeah. It's an actuarial assumption, keyword assumption, the total pension liability in the June 30th, 2022 actual evaluation was determined using the following actuarial assumptions applied to all periods included in the measurement: inflation 2.25%, general 2.75% wages. Was that an assumption or was that the actual escalation at the time?
So what page are you on?
Sorry to digress here. It's page 57 in the ACFR.
All right, so if this is related to the state pension plan,
Yes.
we don't determine anything about those actuarial assumptions. The state's actuary is making those assumptions.
Okay.
And so what they tell us is, here's the city's share of our actuarial results.
Okay.
And here's the city's share of the assets that are been invested.
Yeah.
And then we report that.
You told that, okay.
Yeah, we would more likely dictate these types of actuarial assumptions for the police and fire plan, in which we hire the actuary to do that.
Okay.
And so these assumptions go into every actuarial calculation. I don't know what the state's using, and remember, they're a year behind.
And
Yeah.
generally what they do is they'll do an experience study every 4 to 5 years, so that
Yeah.
they'll kind of lock it in unless there's some significant change. They'll have an experience study. Hey, how do we do over the last 5 years based on these assumptions? Go through a whole process, present it to the board. They'll set those for 4 or 5 years. But then every year when they're remeasuring them, they're also truing that up. So there's an experience gain or loss that's kind of reflected in that liability calculation. But as was said, that board is setting those, and those are based on studies and
Yeah.
kind of set for a period of time unless something changes, and then
Yeah.
they reevaluate it.
Yeah. Yeah, I think we all know what the acronym ASSUME can mean.
Yeah.
Sorry.
I will point out that Jason's long expertise in pension audits is notable, so that's.
Whose is that? Yes.
Jason, his expertise in pension audits, yes. He's done it for many, many, many years.
Well, then you should have coffee with Alderwoman Finlayson and.
Oh, okay. We would have a lot to talk about.
Discussion on that. She's our expertise on that. Are there any other questions? No. I'd also like to thank Kim Aronsky for sitting in the audience through this. She's not on mic, so she can't introduce herself. Sort of reminds me of the State of the Union address. The State of the Union is good.
Yes, it is. Generally, I would say yes. And then when I
I-
highlight challenges, I'm just telling you, these are the hurdles that we have coming up and that we have to address and make sure we've covered in our planning.
Anne Marie, no questions? Just listening? Yeah, okay. Well, that's our first discussion. We just have the next is the Finance Department update. So I guess that's just some internal stuff you're working on, or, departmental staffing, et cetera.
Yeah, I seem to have the same 3 or 4 things I talk about all the time. We're really getting into the last process on pulling a budget together, to pull the mayor's proposed budget together. We've worked with all the departments, so that's coming down to the final 2 weeks. We have about 3 weeks or so before we have to deliver a budget to the council in the form of the ordinance. So Katie and Capri and I will be very busy over the next 3 weeks, and we have meetings with the mayor and the city manager, try to decide, make final decisions on the budget. As Vicki said, we're in the middle of the union negotiations, and those are moving along. And I'm sure Julie's just trying to take a breath before she gets into the year-end stuff. I know she's trying to work on the accounting side. And besides that, we continue to have vacancies that we try to fill and find time to do interviews and review candidates, set up interviews, fill them, so that's always a really time-consuming process, and it just seems to be continual.
Okay. And just for the budget review update, we have solidified the schedule, so, all is good. I don't mean to be rude. I want to thank you for being here. I did have one weird question in your letter. How come nobody signs it? It just says by, your company name.
Oh, personal signature?
Yeah.
Yeah.
Okay.
That's the way
Just wondering.
that's done.
All right. Well, I want to thank you very much for being here and answering all the questions. So unless there's anything else for the good, Alderwoman Finlayson, there you are. Mute.
I come to Wisconsin in all the snow and I catch a cold. I apologize. My question was for Ms. Dickinson. At the last finance committee meeting, you mentioned a position that was moved from your office, I believe, to the IT department. And I got a few questions from staff about posting positions. So I guess my question is, are all of our positions being posted? If we're swapping one person for another or something like that? There was like some questions about civil service positions being posted. So are we posting everything or what's the?
Yes, we are posting everything, and that position was posted, and we're just finishing up our interview process on it.
Bye, Michael.
Okay, so to clarify, the position didn't move. The person that was in my position moved there and then allowed me to fill that vacancy.
So was there a new position created in IT?
They are, yes, they have a funded position there, but it's not a permanent fill. It's not a permanent fill at this point.
So there's no need to post it?
No, there will be a posting, I assume. I think that they're waiting on the grading of the position before they post it.
Okay, I guess I misunderstood. I thought you said you had moved someone from your department to the IT department.
It's yes, a person moved, not a position.
Right, so okay, so the position doesn't change regardless of whether it's in finance or IT.
They have a new job title.
Oh, it just acknowledge your position.
Yeah, Vicki Buckland, Assistant City Manager. I think it's just how just the words that we used might not have been precise enough. The person who had been working in finance took a position that was in IT. And so Jody now needs to fill what now became a vacant position in her shop. So that person took a different position.
Okay, so I guess the question is, was that new position, not a new, but that position in IT posted for all people in the city to have an opportunity to pursue it?
I'm not sure. I would have to, I don't know the answer to that off the top of my head. I would need to find out.
Okay, I appreciate it. I just had questions and I meant to send an email and I didn't, so thank you. And thank you to Mr. Ostrowski for coming and presenting to us today. I really appreciate it.
Oh, thank you.
Did you have to stay overnight, or where are you from?
Oh, I'm just up in Columbia. I mean, I live in Harford County. But
okay.
yeah.
It's overnight.
It's overnight.
Yeah.
Where'd you park?
I would love to stay here overnight.
Do we have a parking pass for you? Won't we have a, we don't want you.
I paid at the new garage. I mean,
okay.
Part of the waterfall.
His money's coming back to, did you take care of him, Julie? Oh. He
We can have it out.
Okay.
That's
I don't know
fine.
how that.
If we plan ahead of time, when we have visitors, we have a method to help for a 2-hour visit.
Yeah.
I think it's a 2-hour or something
passes,
window we
yeah.
can help with, but he just paid and came in. Don't worry, it's probably gonna show up somehow in our invoice.
That was hilarious. Alderman Arnett.
Thank you, Madam Chair. I looked at the briefing, the agenda for tomorrow's work session.
Yes.
And I don't see any attachment. Are we going to get a CIP attachment to review in advance of the meeting?
What meeting are you referring to?
The work session tomorrow on the CIP?
Oh, so I think it's an update of the current projects that are going on.
Yeah.
And that's a DPW thing they're coming to talk to you about. So we need to
maybe
get the question to DPW because they may have some document that they're bringing with you,
I'm glad you asked that.
bringing to you.
Glad you asked that, Alderman Arnett, because for just a little bit of background, because I got a question from my colleague, Alderman Savage, on why we were doing this. Last year, I think it was Director Jarrell actually volunteered to come before the Finance Committee And he actually put together a spreadsheet of all the active projects. You could follow along by the capital budget report. You know, you could. We do have that information, but Alderwoman Finlayson brought, you know, to my attention, like, we should really have the whole city council look at this, you know, hear this presentation, because it was really good last year, especially as we go into the review of next year's budget. We have a good baseline of where those projects are. You know, if some of them are not in construction and we're asking for more money, and, you know, why isn't, so it's a really good discussion to be had. But that reminds me, we really should have Director Vogel. I know he knows about the meeting, but just make sure that he has a presentation of some sort. Assistant City Manager, could you make sure of that?
Well, my question is, we come to these meetings, we don't have any materials, and we get hit with it, so we're busy trying to flip ahead, look at projects that are of concern to us, in the meantime, trying to listen to the presentation. So it would really be nice. We did get the presentation from today in advance, and so that was very helpful. But, you know, to hit us cold at a work session is really not fair. And so I would really request for all department heads, when they're going to be giving a presentation, that we see it ahead of time so we can review and prepare. And it is not attached in the agenda right now. So it would really be good if we can get it in advance.
Yeah, thank you so much for asking for that, because it is really the only opportunity for my colleagues to, you know, everyone has capital projects ongoing in their ward, specifically Alderman Arnett with water lines up the wazoo. So it would be good to have that. And again, it's an opportunity for us to all ask questions about when, where, how, and all that. So, okay, so if there's not anything else for the good of the order.
Motion to adjourn?
Do I have a second?
Second.
All in favor signify by saying aye.
Aye.
Aye. Meeting adjourned. Thank you all so very much.
Thank you.